Hi, good afternoon. Welcome to our fourth quarter 2023 market update. We're happy to be here today and be able to share some of our thoughts of what happened in the financial markets in 2023, as well as talk about what's upcoming in 2024. So my name is Matt Saneholtz, and I'm along with Chad NeSmith today.
Hi, good afternoon, everyone. Thanks so much for joining the webcast. We appreciate the time, and we're both excited about sharing our thoughts about last year and what's to come in 2024.
Absolutely. And before we get too far into our information today, I just want to make a reminder that today's topics are general in nature. If you have any questions about your specific portfolio or your specific financial plan, please give us a call here at Tobias Financial Advisors, and we would be happy to walk through your personal situation. As well, a little housekeeping. On the chat, there should be a chat box feature. Please send in any questions that you may have or think about as we're running through our presentation today. We'll do our best to address those questions as they come in or towards the end of the presentation today as well. Tobias Financial Advisors, who we are. We were founded in 1980 as a public accounting firm by our founder, Ben Tobias. We've grown and been in business for over 40 years now. Currently, we are managing over $700 million of our clients' assets. And with that comes a lot of responsibility. So we really believe in building up our experience and our knowledge and our education. And one of our team's goals is to give back and share that knowledge with our clients and community partners as we are today. People we serve small business owners, retirees, busy executives, physicians, small businesses, retirement plans. We really strive to really help people achieve what they want to in life through a financial lens. We want to make sure that we're helping to build portfolios and help with financial planning to help you and your family reach your goals. My name is Matt Saneholtz. I am the Chief Investment Officer here at Tobias Financial Advisors. I've been with the firm since 2005, and I work with some of our clients as well as work with right alongside with Chad to develop our investment philosophy as well as overall strategy in the portfolio and the day-to-day maintenance of the portfolios. And just a reminder for everyone out there that January is Financial Wellness Month. So hopefully you're thinking of different ways to make yourself healthier from a financial standpoint, whether that be doing fun things like reviewing your spending, or a little maybe more exciting to us is thinking about ways to help build your portfolio and your wealth into the future. And that's what we're here today. Chad, welcome. And
yeah, thanks for having me. Always happy to do these quarterly webinars. They're a lot of fun. We get to take a deeper dive into the presentation. But I am Chad NeSmith. I'm the portfolio analyst here at Tobias Financial. I've been here for about 3 years. I do the trading and research for the firm. I'm a little bit more behind the scenes compared to Matt, but you may see me in some meetings every now and then. But overall, I am doing the day-to-day trading and monitoring of the portfolios. And very happy to be here, especially in Florida, especially in January, when the whole country is seeing snow and temperatures in the single digits. This is our time that the South Florida area really shines right now. So very happy about that.
Excellent. So, just a little bit about a financial investment philosophy here at Tobias Financial Advisors. Hopefully you'll get the theme here through our presentation and the information we're providing is that, you try your best to understand what's happening in the markets, but no one has that crystal ball that can reliably forecast exactly what's going to happen this year or next year or with specific investment classes. So what we really want to do is control what we can control. And that's making a portfolio that fits your needs and your family needs and your risk, how much risk you're willing to take, and known as your risk tolerance, and really try to put your goals in mind as we structure our portfolio around all the building blocks that we're going to talk about today. Stock funds, bond funds, different types of strategies involved in different asset classes, which means diversifying broadly, not only focusing on U.S. investments, but around the globe, companies from around the globe. We want to reduce our expenses and also minimize taxes. At the end of the day, your after-tax returns is what you are really adding to your wealth as you move forward. And so a lot of our current clients understand our philosophy, but if there's anyone watching today who might not be a client, feel free to contact us. We'd be happy to talk to you about how you're currently positioned and where we might be able to add some different ideas to your portfolio. Today's agenda, we're going to go through the 2020 through 2023 market returns, as well as some topics in focus. Chad's going to give us an economic update, what's happening with inflation and interest rates. We'll talk about cryptocurrency and the new Bitcoin ETFs that recently became available in the U.S. stock markets. And of course, we have a big election here in the United States coming up in just 11 months. So that will be a big topic this year, as well as we'll give some insights and forecasts as to what's happening in the portfolios and the economy going forward. But before we go forward, let's take a look back. This is a chart of, on the left here, different banks and financial institutions always like to get out their crystal balls and make a forecast about what's going to happen in the stock market during the upcoming year. At the beginning of the year, the S&P 500, a measure of the U.S. stock market, started the year at 3,853. It closed at 4,769, up 26%. That's a tremendous year, and really kind of unexpected, because the closest prediction of all these different types of banks, institution, actually fell short of that 26% by about 6%. And the average prediction was well under that by 18%. So 2023, there was a lot of talk about recession coming into the year, a lot of pessimism about inflation and interest rates. And so nobody had really forecasted what actually happened in 2023, which we're going to show you coming up in our slides. But it's just a great reminder of, taking a grain of salt with the latest headlines about what's going to happen next.
Yeah, and I mean, this is only a 1-year period, which is just a short amount of time, such a short amount of time in a long-term financial plan. Just last year, the whole market felt really bearish, and now this year, after up 26%, everyone's really happy about the performance of the markets. It just goes to show and how quickly the markets can change with just in 365 days, and how that should not affect your long-term financial plan.
Absolutely, absolutely. So let's dive into what actually happened in 2023. So this is the fourth quarter. The fourth quarter, these green arrows represents just the last 3 months of the year, and it was a stellar end of the year. If you look through the middle here on the average quarterly return, you see on average, dating back to 2001, stock markets return maybe 1-2% across the globe, and in real estate and bond markets even less, right around 1% return. But you can see from the U.S. markets to international to emerging to real estate and even bonds were up substantially higher than their average. And we're going to dive into the reasons why, but probably the main reason is that there was a shift in thinking where inflation looked to be rampant, and that the Federal Reserve, was going to have to raise short-term interest rates here in the United States by a substantial margin. And they did raise interest rates, but they kind of pivoted, and we saw some good inflation numbers that will be reviewed shortly that showed that the economy inflation numbers had turned down pretty drastically. So now everyone kind of took a big sigh of relief that we're not going to see this rampant inflation for so long. And a lot of people who were out of the market or maybe bearish kind of turned sentiment, and everything kind of turned positive. Taking a look at the longer term perspective, the 1 year, the 5 year, and 10 years, they're all green. And over the long term, over the 10 year, we would mostly expect that for just being long term investors and being rewarded for staying in the market for so long. But for 2023, for the whole year, the S&P 500 was up close to 26%. International markets from Japan, Germany, kind of the more developed markets in Europe and Asia, up 18%. Emerging markets, that's China, Brazil, India, some of the countries with smaller countries with higher growth potential, were up about 10%, real estate up 10%, and then bonds which had been typically, as you can see, over the last 5 or 10 years, we've come from such a low interest rate environment. We've now had better yields, better returns in bonds that they are actually paying higher than inflation now, historical inflation. So that's really good for the portfolios overall.
Hey, now we're going to talk a little about asset classes. You can see this this page is just a big sea of green, with the exception of a couple of small pieces at the bottom I'll get to a little bit later. Last year we had the opposite. It was all red, where everything was down. 96% of all asset classes were down in 2022, and we saw the opposite this year, pretty basically, where the Nasdaq was up 44%. That was the leader of the market this year. That includes a lot of the stocks known as the Magnificent Seven. You may or may not have heard of in the news. That's basically Facebook or Meta, Google, Amazon, Microsoft, Apple, Nvidia. Those are the names that really drove the returns this year, and they're heavily weighted in the Nasdaq Composite. Going down, the S&P 500 was up 26%, like we talked about. That's domestic companies. Further down, world stocks were up about 22%. And then as we get lower and lower, the most interesting fact I think here from this is actually gold was up about 14% this year. It's pretty wild when you see gold up that much in a year, because it stagnates for a long time and then participates sometimes in the up market. So that was really interesting to me. And then further down, we have the U.S. bond market up about 5.5%, so still benefiting from fixed income. And in the very bottom, we have China that's struggling down about 11%. And then crude oil was down 10, as you may or may not have noticed at the pumps. Gas prices have come down a little bit this year, and it's a little bit easier to fill up your tank. But China has been struggling a lot, the economy. Consumer spending is still not picked up as much as we would have hoped. They're still a little bit cautious from all the lockdowns during COVID, not spending on those big ticket items like vehicles as much as we think, or like mattresses, things that are really durable goods. And they're also having some issues in the real estate sector. The economy has become really dependent on real estate, and they've had some companies that have gone under some credit crunches and then needed some help from the government. But overall, China, the economy slowed down a little bit, and it's something we're monitoring. But it's one of the few things that did perform very well last year.
Very strong year. Love to see the green on the second part.
Great year, great year. We'll move on to domestic companies. This slide is a little bit busy, but I'll do my best to explain it. Just try to ignore the numbers inside the bar charts, but focus instead on the bottom left of your screen. You can see we kind of start in U.S. returns. This goes back to 1926, so we have about 98 years of data here. 6 times we've had a bear market, meaning you've lost greater than 26% in the U.S. stock market. And then when you lost money at all, it's about 20 times, so about 20% of the time. A little bit less than average, about 14. And then if you move up a little bit, we have the average return at 6, which is between about 8 and 12%. And then the great years that we had last year, 37, almost 37% of the time over the last 100 years, we've had a return in the U.S. stock market greater than 20%. So a really great year in the market, considering how the economy shaped up. We were all expecting a recession that did not happen through the help of the Fed, and then supply chains easing a little bit. But another interesting fact is you may think, hey, this stock market's done really well over the last year. Are we at a market top? Is the market going to roll over? Well, historically, if you invest the year after the U.S. market has a great year, you actually get pretty close to the average return over the 100 years. So about 10.5% return, as you can see in the box, versus the long-term average of 10.3. It's semantics. It's really close. So
yeah,
overall a great year in the U.S. market.
Absolutely. And what sticks out to me here, Chad, is just kind of the average return. We often are asked, what can we expect on average? And on average, well, over the past 100 years or so, 98 years, we were up over 10% on average. But when you look at the average sequence, there's only 6 times where you actually were in between 8 and 12%. And so I guess you just can't, that's just how numbers work and statistics, but it's really just have to, stay invested over the periods of both good and bad, that then result in an average return of 10%, which I think everyone would be pretty happy about. So that sticks out to me, that the average is like one of the lowest percentage times of actually happening.
Happened in practice, right? And it shows how volatile small stocks can be generally, just because you can be up 20%, almost as much as you can, you're losing money a little bit over a quarter of the time right now in stocks over the last 100 years. So everyone predicts the stock market to be, hey, we're going to get 10% this year, but like you said, it happens rarely that you actually get that 10. I think we're going to move a little bit over to the economy. We're going to talk away from the markets. We'll talk about the economy a little bit. We have GDP. We're going to start with GDP, then we'll go into some inflation, and then we'll talk about the Federal Reserve. This is GDP dating back to 2021, so we're coming out of the lockdown. And we had really strong GDP in 2021. On the far left of your screen, we saw GDP returns of 5%, 6%, up to 7%. A lot of that was driven by consumption. As you can see in the lightly blue shaded area, consumers were spending out of COVID. They got the really low mortgage rates, and they had all this saving pent up, a lot of government money that was handed out to a lot of people, and we saw it in consumption. And a lot of everyone was worried, will that consumption keep happening? We had a little bit of softness in early 2022 whenever we saw inflation really peaking its head up, and the Federal Reserve was starting to increase rates, where we were getting those 0.75 of a point interest rate increase during that time. So we had negative GDP of down 2%, but that was coming off of like really heavily strong growth the previous year. So it didn't really feel like it didn't really feel like the economy was slowing down much, just because things were so hot coming out of the lockdown. And so then a lot of people were concerned that the Federal Reserve tightening would slow the economy down. But what we've seen is consumption has really driven the economy since then. We've seen it drive going into the positive 2% that we saw in the first quarter of last year, up to 4.9% growth that we got in the most recent GDP data, and that was driven a lot by consumer spending. A lot of consumers that own homes especially have low mortgage rates, so they're just directing those dollars elsewhere. I do think that there's some anecdotal evidence with all of the money that Taylor Swift is making from her concerts. I have friends personally that are traveling to Singapore in 3 weeks to see Taylor Swift. So just know that people are spending money, and it's supporting the economy, and it's something that we think is going to continue, because it's doesn't really show many signs of slowing down in the near term. So we're not really expecting a recession this year, and neither are many economists in the economy. So overall, that's good GDP data. We'll look at inflation here. Now, this is an inflation chart going back to 1973, so 50 years of inflation data. As we can see on the far left, we got the oil shock inflation that we saw, the 12% in the 70s, and then got up to almost 15% inflation in the 70s. And then it tamped down, where inflation wasn't really in the story for much of the 90s and 2000s, and in the 2010s when we had the low interest rate environment. But we see the spike that we all lived through here in the 2020s, and it got up to 9.1%. But as you can see, it's coming down, and it's been coming down consistently. And this is the promising data that's caused the Federal Reserve to kind of step off the brakes with the economy right now, and it's caused the market to be really happy with what's happening in the economy. And we're thinking that the Federal Reserve is going to start lowering interest rates going forward. But as you can see, the 50-year average at headline CPI, which is Consumer Price Index, was 3.9%. We are now below the 50-year average. That does include the really high inflation we saw in the 80s, but still, it's trending down towards the Fed's 2% inflation target. And we do think it's going to continue to go downwards, particularly because there's a lot of lagging effects from shelter inflation. As people re-up their rents, that data is going to flow through the CPI data, and will help bring the inflation data down as we see it. So we're thinking that inflation will trend down closer to the 2% over the next year. And so far, so good. We're just hoping that things that are happening keep happening in the economy, and the Federal Reserve should follow suit. So let's go on to the next slide. We'll talk about interest rates. As you can see, this is the Federal Reserve. This is called the Fed funds rate. So this is short-term interest rates, and this is what reflected to paid on a lot of money market and a lot of cash returns. You may be excited you're getting 5% on your money right now, on the cash money that you have in the bank, but and that's because the Federal Reserve, the Fed funds rate's at 5.38%. Expectations are the Federal Reserve is saying they're going to cut rates, and the market is expecting that the Federal Reserve is going to cut rates, so rates are going to be heading down. The Fed is expected, or they're saying they're going to cut rates about 3 times this year, and the market is expecting that they're going to cut 6 times this year. So you can see in the dark blue line on the right side of your screen, At the end of the year, the Fed is projecting there'll be around 4.6% on average on the Fed funds rate. That's a survey done by all of the members of the Federal Reserve. But the market's saying, hey, you're going to be under 4% this year. We think that you're going to cut more aggressively, not because the economy is doing bad, just because you don't need to be as tight. You don't need to slow the economy down as much because everything's just going orderly right now and things seem to be fine. And interest rates will trend down over time, over the next several years, closer to the 2%, 2.5% long-term Fed projection. We don't foresee that we're going to go down to 0% interest rates anytime soon. We think we're going to have more normalized interest rates going forward. But overall, this is,
sorry, that's the term that you often see in the news, the soft landing, where that the Fed was able to maintain, reduce inflation, as we saw in that last chart, really maintain it and lower inflation, as well as not have unemployment spike and a tremendous slowdown in the economy. So that's people are excited. You know, that's why we saw the markets kind of do what they did in 2023. People are excited that, you know, maybe that we are going to hit the elusive soft landing. And that's one of the reasons, you know, as Chad's explaining here, that the market is expecting some short-term cuts in interest rates. But the next meeting up in March, and I think you're expecting a cut as soon as March, Chad, or?
No, I think they'll hold tight for one more. But you know, we may get some data coming out in the next couple months, and they may change their minds. Mm-hmm. It's all data dependent and all data driven. But for now, rates are high. They're going to trend downward in a downward direction, and it's going to benefit stocks. It's going to benefit bonds, and put us more in line with how the economy's doing.
Yeah, and just graphically, this is a great picture of what some may refer to as peak interest rates, where this would be, as it sounds, the peak in interest rates for this cycle. That's many times we've seen this in the past. So when rates start to come down, that's good for a lot of different financial assets.
Mm-hmm. Now we're going to get into the most exciting portion of our presentation. There's a Bitcoin ETF because everyone's excited about it right now. Bitcoin, just generally. Bitcoin's up over 100% over the last 12 months. This is more of a longer term chart going back to 2020. If we wanted to go really long term, we go back to 2013, whenever it was really came in the mainstream. But overall, you can see, you know, the most recent cycle where Bitcoin peaked at almost $70,000 a coin in 2021, and then just got slashed. I mean, it came down really heavily down into what was called the crypto winter, when FTX declared bankruptcy and a lot of exchanges got into trouble with regulators. And it was looking like Bitcoin may not be accepted and may not be mainstream as quickly as anticipated. So people were out of favor. Bitcoin is out of favor. And now with the release of these Bitcoin ETFs, a lot of people are speculating that Bitcoin is now in, and you should buy these Bitcoin ETFs. And we see people buying these Bitcoin ETFs, but we have a lot of trepidation. We don't recommend these things for several reasons. We've got some of these listed on the next slide, but number one, Bitcoin doesn't pay interest. It doesn't give you a coupon. It doesn't reward you for holding the asset for long term, other than the hope that you would sell it for higher to the next person willing to buy it. It also doesn't produce anything. It's not a company like Coca-Cola that produces a beverage that makes profit. It doesn't have earnings or assets. It also doesn't pay you a dividend. The third reason of many that you shouldn't buy Bitcoin is it's a very volatile asset class. You can be up over 100% like we saw last year, or you can be down 65, 75% in a single year. And that doesn't bode well for your plan. It's just extremely volatile and very risky. And then coming up, it's going to face some competition from digital currencies. The dollar may be going digital in the future, and this could put some pressure on the price of Bitcoin. One story I like to tell as far as competition goes is back in 2007, Garmin was the leader in all mapping. They had all the GPS tools that you needed to find your way to where you were going in your car. And that year, Google said they were going to have Google Maps on everybody's cell phone next year, and the stock was down 20% in that single day. And the stock plummeted from $120 a share to $17 just because of competition. So we're definitely fearful of new coins coming in to the market, and we're fearful of new currencies transforming into digital currencies and really putting pressure on the price of Bitcoin.
Yeah, I'll just add that to that very point, I've seen statistics out there that there's currently over 1,000 different types of cryptocurrency or digital coins, and so there's already competition just amongst those existing coins, and surely be more trying to be established in the future. And also, the SEC, the Securities Exchange Commission here in the United States, although the structure of a vehicle, an exchange traded fund or an ETF to trade Bitcoin more easily, has been very clear that although this is an approved structure to facilitate the trading, it is not an endorsement on the actual investment or the actual cryptocurrency or the actual Bitcoin. So be very careful when you are thinking about adding these things to the portfolio. And right now we are, as Chad, for these various reasons and more, are not widely incorporating this into our portfolios at this time. So up next, the 2024 presidential election. We just had the results of the Iowa caucus, and there's no doubt going to be a very major election here in the United States. There's going to be a lot of twists and turns, a lot of ups and downs. There's just a lot of different things happening in this election, and even last year. I mean, last year we had a congressman expelled from the House at a certain point in time. We've had president not be on a ballot for a certain state. I think that's headed to the Supreme Court. So there's a lot of different things happening in the election cycle and the political atmosphere, and it's very hard to kind of translate that into the market. So I think we want to show this statistic here that kind of the first half of the presidential elections for that year, when there is a presidential election, is kind of sluggish to start in the U.S. stock market. As the year goes on, maybe when there's a little bit more certainty about who's going to be elected, then the economy and the stock market in particular, does a little bit better in the second half of a presidential election year. These are averages. We can't necessarily hang our hat on these or really react to these, but it's just kind of interesting data that we came across that we wanted to share. But ultimately, we don't want to let how you feel about politics or a particular politician or political party, in fact, override your investment decisions. This is another great chart, just dating to 1961, of a growth of $1 here in the United States. And it's really not necessarily who's in charge or what political party is the leading in the White House. It really comes down to the economy, capitalism, rules, laws, structures that we all enjoy here in the United States, and that framework has provided the growth, the economic growth over time. So really, don't use your portfolio to vote. use your actual vote to hit the elections this upcoming year, and you're going to get hit with different texts, different ads, different ways that politicians will try to win your vote. We just want to be careful that doesn't trade to different investment decisions and really making your emotions help drive how you feel about the economy or about investments.
Mm-hmm. Yeah, I mean, I think that politics should stay out of investing for the most part. And just to reiterate what you said, Matt, you can't make dire decisions on your portfolio based on who's in office and who's not in office in any given year.
Absolutely. So we'll see. We'll see what it looks like. I've already started getting texts on my phone, different politicians wanting support. So yeah. It's going to happen. Let's get ready for it.
Yeah. Yeah, the political spending is definitely going to be a thing, and a lot of people are going to get a lot of ads. Just in Iowa, per person that was voted last week, it was $1,000 spent on each voter that voted in the Iowa caucus. So expect those texts, expect those ads, but don't change your portfolio because of it. But to get back into our portfolio and the positioning that we have in portfolios, just general overall positioning in portfolios, we'll start from left to right. Fixed income. This year we extended duration, meaning we bought longer dated bonds. These are bonds that are going to mature in later dates. maybe like a 7 to 10 year time period versus a 2 to 3 year time period. And that's to offset potential declines in stocks. When interest rates fall, these bonds tend to do better, and they also have a less correlation to stocks, meaning they may offset declines in the stock market better for your portfolio. As far as the quality of bonds, we're keeping them high. We're running a lot of treasuries, a lot of agencies. We're not really reaching up and buying what's called junk bonds or high yield bonds because we're not really getting paid to take the risk right now, and we're seeing defaults pick up in the space. So we're just staying with the safe stuff on the fixed income side, and we're getting closer to about a 5 or 6 year duration, meaning our bonds are going to mature within 6 to 7 years, something like that on average. On the stock side, we're maintaining our international exposure. We think the international stocks are very attractive. They're at about a 35% discount to domestic stocks right now on a price to earnings basis, and they're also under their 20-year average, while domestic stocks are over their 20-year average on a price to earnings basis. So they're cheap historically speaking, and you're also getting almost a 2% higher dividend yield to buy international stocks right now. And a lot of these stocks, a lot of these companies you're familiar with. They're Toyota, Samsung, HSBC Bank, Barclays. There's a lot of world-known, worldly stocks and worldly companies in this index, and we find them attractive right now. And we also think that emerging markets are attractive. We're getting about an 8% earnings yield on both emerging markets and international right now. And eventually, the market will get excited about the space. Right now, the market's focused on AI, and we are invested in that space, but we do believe in a truly diversified portfolio, maintaining this exposure. We do think that eventually people will get excited about international, we'll get excited about emerging markets again, and we should see some performance going forward. On the opportunistic side, we do have preferred stock. We're getting about a 6% yield right now. And that's 6% that's taxed as a dividend, meaning it's taxed preferred at about a 20% rate versus regular interest, which can be taxed at your ordinary income rate. So we do like the tax benefits of preferred stock. And this year we also sold our clean energy position. Solar stocks were under a lot of pressure this year, and we decided to exit that position in exchange for floating rate treasuries we have in the portfolios now, yielding a little bit over 5%. So that's generally where our portfolios were positioned this year. We're going to look forward into 2024 and hope it's a good year for our portfolio. But we have some points to talk about on the next slide, where we're going to talk about 2024 and what we can be excited about as investors. As Matt mentioned earlier, we are at peak interest rates. As we saw, we were up at the 5.38%, and we're expecting the interest rates to go down. Historically, this is a really good time for investors. As interest rates go from higher to lower, it is generally supportive of bonds, it's supportive of stocks, and it's really beneficial for investors, historically speaking. The labor market continues to do very well. People are looking for jobs again, and supply chains are improving. We added 216,000 jobs last month, and it's not slowing down. People are still hiring. People are still looking for jobs. Participation rates are up a lot. And that's helping corporate earnings because they're able to find talent. And so corporate earnings continue to be very positive. We just got some data out from JP Morgan. They're doing really well this year. So far, they did well in the fourth quarter last year. We expect that to continue in 2024. And then also stock market valuations, as I talked about on the last slide, they remain attractive. We're getting about, it's like 19 times earnings for domestic companies right now, and about 13 times earnings or 12.8 times earnings for international stocks. And that's at 8% yield I talked about a little bit ago. But we do think that's attractive for investors. Now with the good news, we'll talk about points of caution. The things that we're keeping an eye on, and probably the biggest risk of the global economy right now is the geopolitical risk we see with the conflicts in Ukraine and Israel war. I mean, it's something you really cannot predict. We do not know if it's going to spill over into different parts of the economy or different parts of the world, but it's something that's very sensitive, and no government wants this to happen. People don't want war, but it happens. And it's just something that could put pressure on trade, put pressure on the economy. We could see supply side issues again. We could see inflation come back because of these conflicts. But as of right now, it seems to be settling a bit, or at least not growing like we are watching for, or we don't expect it to grow, but it's just something we're watching. Another thing that could be cautious about is commercial real estate. The work from home is still in. People work from home more. And commercial real estate could come under pressure because they have these long leases where they had the space leased out, but people just weren't using the space. And now these leases are coming up and they're starting to roll off. And these commercial real estate office buildings are having trouble renting these to the next person that comes in. So that could face some headwinds. It could potentially, in worst case, spread to banking because they own a lot of these loans and the space is very leveraged. But it's something we're watching very closely and something that could provide some caution for us in investing. And then when we get to the, I guess the U.S. government, the federal government side of it, the interest expense is growing as a percentage of federal revenue, meaning tax revenue. And so historically speaking, interest expense as a percentage of tax revenue, that's interest that we're paying on treasuries, the government is paying on treasuries. So when you buy a treasury bill, you get that 5% that's paid for by the federal government. That's what we talk about interest rate or interest expense. Historically, it's between 6 and 10% of tax revenue. Right now, we're at about 15% of tax revenue. And in about 5 years, the CBO is expecting it to be about 20% tax revenue. So it's an issue that we're paying attention to. It could cause higher interest rates in the future. It could also cause higher tax rates in the future. Just some things that we're watching. We're watching and some things we can potentially be cautious about.
Yeah, it could be a theme of our political and presidential elections this year, of kind of getting the deficits in the budget kind of more in order, so that we're not spending so much money on just paying back debt. You know, kind of like a household getting their debt picture under control. I don't know if we'll see that quite yet with the political climate we're in, but it's definitely something that could slow down the economy and ultimately higher raises, increases in taxes, which would likely slow down the economy to some degree. And so these are definitely, I think last year was like interest rates and inflation. This year is more politics and global war and global tension. We'll see what kind of headlines we see in those arenas going forward, but those are the things that we can't control, and that goes back to our investment philosophy and on staying invested. And yeah, we tweak the portfolio, we rebalance the portfolio, and we do make some shifts, but we can't necessarily go so far either way that we're making big predictions on short-term themes or occurrences in the world. Which leads us kind of to our next approach here on long-term investing.
Yeah, long-term investing. This is a nice slide to kind of like wrap up our presentation today. This is just general diversification, and this compares returns of the S&P 500 to a diversified portfolio that includes the S&P 500, some mid-cap stocks, international emerging markets, and about 40% fixed income, 40% bonds. And it goes back to the year 2000, where the dot-com bubble was at its peak. And as you can see, if you had started in the year 2000, you're a little bit better with a diversified portfolio looking back, but you got there in a much smoother way. So for example, in 2000 to 2002, you can see it started at down 40% for the S&P 500, but this diversified portfolio was down 15. And you may get upset because you lost money investing, but you didn't lose as much as the S&P 500, but it still doesn't feel good to lose money. It never feels good to lose money. There was a period of time from 2003 to 2007 where a diversified portfolio outperformed the S&P 500. And then we get right back into the cycle in 2008 where you still lost money. It didn't feel great. But then the S&P did well from 2009 to 2019, where you didn't make as much money in a diversified portfolio, so you may feel that FOMO. But overall, investing, it causes a lot of emotions. And we want to try to remove those emotions out of the portfolio and out of your investing decisions and create a smoother ride to try to limit any kind of harsh decisions that you may make in the portfolio, and stay invested for the long term. That's what a solid financial plan is set for, and that's what we're here to do at Tobias Financial, is to drive you guys to a good financial goal and to meet your goals.
Absolutely, Chad. This is I love this chart. There's just so much power into being more diversified, not all your eggs in one basket. Typically, history shows here, it's a bit of a smoother ride. Hopefully, should be able to help you sleep better at night, knowing that you are diversified across different types of asset classes, and you're not so tied up into one, the U.S. stock market. And so, I'm looking at the chat here. It doesn't look like we had too many questions come in at this time. So at this point, I'd just like to remind everyone that we're here to talk and to provide insight into your portfolio and into your financial plan. So if you are interested in learning more, please reach out to us at Tobias Financial Advisors, and we would be happy to speak with you. Wishing everyone a happy 2024.
Thanks so much, everyone. We appreciate the time, and we'll see you next quarter.
Thank you.